Hey guys, it's Max. Welcome to a chilly day here in Austin. Hope everybody's having a good day. Okay, let's look at the market really quick. We're going to talk market timing, which I don't believe you can do, but effectively, but it's fun to try. At least I can't do it effectively. I'm still trying to learn. I'm going to show you what I got, what I've learned. Here's a trick I know. This is also I do a lot of content for the visual learners. So let's say you're a logic oriented guy or a visually oriented guy. Um, these gaps that I keep talking about, where the stock doesn't trade and the price it doesn't trade overnight, when a situation like that occurs where there's a gap, especially if it stays open longer than a day or two, where it doesn't trade in that area, that means there was pretty strong um, there was a lot of buyers there pushing the stock out of there was an imbalance there. There's whether it's bullish gap would be buyers, bearish gap would be sellers. So the first time that we come back into the gap, like there was a gigantic election gap's the perfect example. The first time we came back into it, it was November 15th, 14th, 15th, 16th. Within 3 or 4 days, buyers emerged and shot it out. Then the 20th of December, same thing you know, then the same thing on January 2nd, and then the same thing the other day on Monday the 13th. It made what appears to be a low. Okay, well, so in the meantime, just between this morning and yesterday, we've left behind a gap. Now, let's pull up a shorter chart. We'll pull up a 30-minute chart. This lower gap right here, well, this lower gap right here is barely hanging on. I mean, they got to the very bottom of it. I could really probably take the lower gap off the screen. Um, well, I don't know if there should be buyers the next time they get in the lower gap. However, for now we have a bullish gap above that. So if you could make a play, if you're bullish, you could say, okay, well, I'm going to make a play that this gap stays open. Now I'm going to bet the market goes up too, but I'm just betting that at least the market doesn't go down. So you look at the SPY, the open area is between 589 and 582. So then you can go over here to option strat. This is the final product, but I'm going to put it together one at a time. Okay, remember 588 or 589 and 582 were key areas. Let's put this trade together. Okay. You're betting it doesn't go below between 588 and 582. Well, you can use those numbers. You can sell and that's what you would do. If you're betting it doesn't go below it, you sell the 588 strike. Okay. So you could do that, and that's fine. It costs you $22,000, but you make $300 as long as the SPY doesn't go down more than 0.8%. You're going to hold on to that $300 no matter how far it goes up. Okay, but it's a lot of risk on the table. So what a lot of traders do is they buy a put that's further out of the money. Like lots of times we do 5 points. So if we do 588, we might do 583, but that box happened to go from 588 to 582 just for what it's worth. So what we're doing is we're just putting a fence around that box. We're saying if it goes below that box, we're out. We don't want to lose any more than that, but we're going to take a chance that it doesn't go below that box at least. And in fact, if it stays where it is or doesn't drop more than 0.7%, we make $210 income, and we only risk 990. So now we're making about 25%, 22% or something. So that right there to me is a better trade than making 300 but risking thousands. Okay, so that's the base trade for what I was recommending, and you could do just that alone. That alone would be a great way to play a bullish. That'd be a great way to make a bullish play on the SPY for the next 3 days. 17th is Friday. You just don't want it to drop in the next 3 days. If it drops, you lose. If it stays here, you get to hang on to your $216. Okay. So all I was showing is you could add a call to the party, spend part of your income, your credit on a call option. You don't need two of them though. You just need one of them. You could buy two of them, but then you don't have that much credit left. But on two of them, messed up the strikes. Well, let's go over here. Here's the one I saved just a second ago. The 588, 582. There was $151 credit on $1,000 worth of risk. So about a 15% return. The prices are changing right now. Maybe the market's moving or something. Also, of course, we would do this trade in Tasty Trade, not Option Strat, but Option Strat has better visuals. I like what I'm trying to illustrate with Option Strat is this type of trade. You have a 71% profit. This ghost looking thing is your probability cone. Most of the occurrences, like 85%, fall between this hash mark and this hash mark, the center of the cone, in other words. Then you have about another 14% that fall out here, and then a 2% that go beyond 2 standard deviations. But most of the occurrences are within this cone. So if you look within this cone, you can see why it's a 72% profit, especially within the inner part of the cone is mostly profitable. So just from a chart standpoint, if you like charts and you believe that gap will be supportive, I'm just showing you how to play the gap, but use the actual levels to choose which strikes you sell, just as a starting place. And then you're just betting that it doesn't get into there. If you're a visual person, the good thing is it doesn't matter if the price doesn't go straight up. You still do all right. Now, I think what they're probably aiming for is the previous high, which is right there at 608 or something. So I wouldn't be surprised if they gun for that over the next 3 days. So that's the reason for the extra call out there. If they do gun for 608 and they happen to get it, they may not, but if they were to get it, it's $1,000 winner on $1,000 worth of risk. But basically, you're just hoping for a stable market. All right, so let's go back to the one that's live and see the prices are moving. Let's do it this way. Just have to make the same trade. Okay, so here's $113 credit on $900 risk. It only has about 0.5% buffer. Okay, I think I fixed it now. So we'll do 588. Yeah, there we go. Perfect. 588, 580, 588, 582. Perfect. That's easy. That's not a bad looking trade. $1,000 worth of risk. You get 13% of it back right away, and you have a pretty big 0.7% buffer over the next 3 days. 72% chance of profit. You have theoretically unlimited, partially unlimited upside, especially if it moves fast. If it starts moving up, fast, and it's even if it's just like at 603 or 601 by Thursday, it's worth 500, $600. If it's at 605, it's worth $700. So, but if it stays right here in the flat spot, which it usually does, that's most of the occurrences. As long as it doesn't drop more than 0.7%, you get to hang on to the credit. So I'm going to hit save, and I'll share this with you guys. So this would be a bullish play for end of the week. If you aren't bullish, don't play this. If you don't think that gap's going to hold, don't play this. But what you might do is just don't do anything, and then wait. And if the market goes up for a little while, maybe hits this. We have resistance overhead. Maybe the market goes up, hits this resistance, then comes back down into this gap. Maybe that's when you want to. If you're bullish, maybe you want to wait for it to come back into this gap. But I'm just saying, if you think that the low's in, which is kind of what I'm thinking, I kind of think the low's in. I don't know. Maybe I'm wrong. Here's bond yields. They've come crashing down. When they were going up, it was pressure on the market, but they've broken their uptrend. Not that they can't turn around and go right back up. Here's volatility. It's coming down too. So I don't know. I wish I would have known this yesterday, because it'd been better to do a trade like this yesterday and use this gap down here for my strikes, sell the 580, 575. But I didn't know yesterday. I hadn't made up my mind yet. But anyway, just one of many ideas. Bullish play for end of the week. Like I say, there's other ways to do it too. This isn't the only way to do it. It's just one way. And I just like to talk about it because it deals with selling options. The basis of this trade is you've sold puts, and puts are overpriced on the SPY, and you've sold puts to finance, or you've sold a put spread to finance kind of a mild little YOLO where you might make $1,000 if it goes there. If it doesn't, hopefully you're just going to make 150. It's just, a win-win 71% of the time, right? That's the whole idea. All right, guys. I appreciate you all for being here. I'll share this trade. All right. See ya.